So there's going to be some things in this video that hopefully opens your mind, lets you know that I really don't take a biased opinion, but I'm going to tell you right now, this is pretty eye-opening.
And it had been up when Sarah was doing it at the top of the show, 110%. Yeah, the meme trade may very well be back. Roaring Kitty, remember that name of Wall Street Bets fame? He's returned, and shares of GameStop are up as a result. Stock's been halted 7 times since trading got underway.
A lot of other short names are starting to move as well. I don't know if this is short companies or short funds getting nervous that this might be meme stock 2.0 and covering, but
Now let's revert back to what happened this week. It was all about the meme stocks and people taking on ridiculous risk. Or was it shorts closing out positions? Either way, there's a big repositioning taking place. We're talking about multiple stocks jumping hundreds of percents in a very short period of time where the risk tolerance now, we're definitely starting to reach that greed factor. This market's all about maximizing returns, taking on a tremendous amount of risk, and not really thinking about the downside. And there's a couple things we can look at here. Obviously, the greed meter is telling us that people are definitely risk on, and we're trading at historically high valuations. We're actually trading in upper decile as far as valuations go. And when you look at trading at this type of earnings, usually returns diminish going forward. So the current valuation is stating that you need to be careful, but I'm going to show you some other things that are alarming here. The one thing I want to highlight is the put and call ratio. Put and call ratio is at extreme greed, which is actually going to push the market even higher, essentially leveraging the stock market in a sense. And with the VIX in a neutral state of mind, there's not a lot of people putting their bets on that volatility could come around the corner. We have 2 wars going on. We still have extremely high inflation. We have an inverted yield curve and a Fed that doesn't know what the heck they're doing, but yet everything is calm, and this is when you need to be alerted. Now, I'm not trying to scare anybody and I'm not trying to throw any crazy stats out there, but here's what I want you guys to take a look at. We haven't seen this type of move since 1999. And what am I talking about? In the blue is the Russell 2000. And I want to take you back to 1999 and the dot-com bubble when the separation of the S&P 500 absolutely skyrocketed past valuations of small cap companies. What's important about small cap companies is they are the true dictator of the economy. When we look at the way that the S&P 500 is diversified with the top weightings being mainly 7 tech names, it's really not a true indicator of what's going on with the economy. And what did we see take place in the late 90s into the early 2000s? Is a massive separation on valuation from small caps, meaning the true economy, versus technology, because the dot-com boom was happening and small caps were left for dead. But then take a look at how valuations caught up. Small caps actually kept up and outperformed markets in true bull markets. And so now I'm starting to scratch my head because here we are today in a very similar situation to when the dot-com bubble happened. But now, in my opinion, it's the AI bubble. When we think about the capital expenditures that companies have to make to even participate in AI, it doesn't make sense that all these valuations are getting stretched. But when we look at the underperformance of small caps, the Russell 2000, we're starting to see a very similar setup that we had in the dot-com bubble, where this is the blow off top that I've talked about. And this is why I'm still sticking to my guns, ladies and gentlemen. 2025 will bring a recession at some point in time. Recessions are part of economic cycles. We are what we called in a euphoric stage right now, and this is usually end of cycle behavior. Almost everything I can line up is exactly what's taking place. When we look at the cycle pattern of emotions when it comes to the investor, we were in the excitement stage with all the stimulus being passed and the CHIPS Act being passed, which now is leading us into euphoria where we have a tremendous amount of liquidity on the sidelines and everybody's now getting FOMO, and we're starting to see that through the meme stocks and multiple moves throughout the day that almost don't make any sense. Then we go into a flattening stage of consolidation where the market stops its gains. People start questioning some things, but they're still optimistic because they're in denial that things must go higher. And then all of a sudden we get the fear and panic. And that's going to be some time, and that's why I think that's going to be the 2025 setup here. And so how am I positioned? As most of you guys know, I've definitely been positioning more on defensive stuff. I'm looking for undervalued healthcare that pays dividends and undervalued technology that pays dividends. Along with that, I'm starting to look at small caps as possibly a really good setup for longer term here. As we saw by the charts, small caps tend to not fall as hard, especially where valuations are right now. They're trading at 1990 levels, especially in comparison to the S&P 500. But yet, if we do get a market sell-off, they probably won't sell off as much because they're already discounted extremely. But then when they do start catching up in a new bull market, as we saw by the chart. When it's a true bull market, small caps should actually outperform, and they haven't been. So now what are we waiting for? What's the confirmation that I'm personally looking for? I'm looking for that 3-month to 10-year to close the gap and go back into a normalized yield state. At that point in time, I absolutely think the clock is ticking, but what is holding everything up is obviously, guys, the labor market. There's no question about it that the labor market is super strong. That is going to be a lagging indicator. I think the leading indicators, the more I look at this, is small caps underperformance, letting me know that this is not truly a bull market. This is more a stage of euphoric behavior on the AI movement and with government stimulus. When we have the inverted yield curve, political tension, euphoric behavior, Fed's tightening, this is end of cycle, which means that a recession is more than likely coming. The problem is when. Because people have been calling for recession for an extended period of time, including myself. I thought there was a possibility before student loan moratorium was passed and before the CHIPS Act was passed that we would actually go into a recession. But once those bills were passed, I became extremely bullish towards the end of last year and actually rode a majority of this move up. Now, as of recently, I'm underperforming the market, but I think longer term, I'm going to be set up better. So the thing to keep your eye on is going to be as the job market starts to kind of crater here, we're starting to see some cracks. Not as many jobs available, and now we're starting to see unemployment tick up to 3.3 up to from 3.6 up to 3.9, and we're also seeing hours worked come down as well, which is now signaling that something's going on here with the labor market we need to pay attention to. As I stated before, I don't think you need to be freaking out or pump the brakes on anything, but when I look at the performance of small caps to where the S&P 500 is trading, when I look at the inverted yield curve starting to close the gap, and I'm looking at unemployment starting to kind of tick up here and signal that something could be reversing, this is coming to a head, and it's coming to a head very, very soon. Now, of course, this is just my opinion, but where I'm seeing the opportunities, as I stated, I think small cap to mid cap could be pretty interesting, especially those companies that are actually profitable. If you can actually sift through some of the indexes and figure out which companies could handle a downturn and have good balance sheets, I think you might actually outperform there. The other thing is the underperformers. That's going to be your healthcare and consumer staples. The nice thing is those dividend yields are actually pushing what 10-year treasuries are pushing, but you also have that inflation hedge with EPS growth. Now, of course, the initial move I think is going to be down if we go into recession. I just think the downside move for those are going to be a lot less volatile. And I think their earnings are going to be pretty strong regardless of what the economy is doing. So as always, guys, this is just my opinion. Hopefully you enjoyed it, and we will see you in the next one.